Hi guys. So in chapter 9, problem E9-17, we are given the following. NASCAR motor assembles and sells motor vehicles and uses standard costing. Actual data and variable costing and absorption costing income statement related to April and May 2014 are as follows. Prepare an income statement for NASCAR motor in April and May under throughput costing. We're given the following data for April and May. Beginning inventory, production, sales, variable costing, manufacturing cost per unit produced, operating marketing cost per unit sold, fixed cost, manufacturing cost, operating marketing cost. The selling price per vehicle is $24,000. The budgeted level of production used to calculate the budgeted fixed manufacturing cost per unit is 500 units. There is no written off to the cost of goods sold in the month in which it occurs. Direct material cost per unit for April is $6,700. $6,700 for May. Direct manufacturing labor cost per unit is $1,500 for April, $1,500 for May. Manufacturing overhead cost per unit for April is $1,800 for April, $1,800 for May. We are also given the variable and absorption income statement on the right side. With the data provided, I have circled the relevant values that will be needed to incorporate the income statements for NASCAR in April and May under the throughput costing. To begin that, we must find beginning inventory, production, goods available for sale, units sold, any inventory for April and May. It tells us that in the beginning inventory for April, there is zero production, zero units. In production, there are 500 units in production. Goods available for sale is calculated or found by adding beginning inventory of 0 units plus production of 500 units, which gives us a total of 500 units in goods available for sale. Units sold in April is 350 units. To get any inventory, we will take goods available for sale and subtract it by units sold of 350, which will leave us with 150 units in ending inventory for April. Beginning inventory in May is 150 units. For production in May, it tells us that there are 400 units in production. To get goods available for sale for May, we will take beginning inventory of 150, add it to our production of 400 units to get a total of 550 units for goods available for sale in May. It tells us that there are 500 units sold in May. To get any inventory, we will take goods available for sale of 550 subtracted from units sold of 520, which gives us 30 units for any inventory. I have created a template with the yellow highlighting. The answers in the yellow highlighted part will be transferred to the person answer. To construct the income for the throughput costing for April and May, we will need revenues, direct material cost of goods sold, beginning inventory, direct material and goods manufactured, cost of goods available for sale, deduct any inventory, total direct material cost of goods sold, throughput margin, other costs, manufacturing costs, other operating costs, total other costs, operating income. For revenue, it tells us that the selling price of a vehicle is $24,000. We sold 350 units in April. Revenue of $8,400,000 is derived from multiplying 24,000 selling price of 350 units sold. For beginning inventory, there is zero inventory, 0 units for beginning inventory in April. To get direct material and goods manufactured, we will take 6,700 from the direct material cost per unit in April, and multiply that by the 500 units in production in April. To get 3,350,000. To get the cost of goods available for sale, we will sum up beginning inventory of 0 units plus direct material and goods manufactured of 3,350,000. Which gives us a total of 3,350,000 for the cost of goods available for sale. To deduct any inventory, we will take 6,700 from direct material cost per unit in April and multiply that by our 150 units of any inventory in April. Which gives us 1,005,000. To arrive at total direct material cost of goods sold, we will take cost of goods available for sale of 3,350,000 and subtract it by deduct any inventory of 1,005,000. Which gives us 2,345,000 for direct material cost of goods sold. For the throughput margin, we would take our revenue of 8,400,000 and subtract it by our total direct material cost of goods sold of 2,345,000 to get an answer of 6,055,000. For the manufacturing cost, we will take the sum of our direct manufacturing labor costs per unit, 1,500 from April, plus our manufacturing overhead cost per unit of 1,800 from April, which gives us a total of 3,300. And we will multiply that by our production in April of 500 units. Also adding that with our manufacturing cost of 2 million. Which gives us a total of 3,650,000 for manufacturing costs. To get other operating costs, we would take 3,000 from April from the operating marketing cost per unit. Multiply that by our units sold in April of 350 units and adding with our 600,000 of operating marketing costs in April. Which gives us a total of 1,650,000. For total other costs, we would sum up manufacturing costs of 3,650,000 plus other operating costs of 1,650,000. Which gives us a total of 5,300,000 for total other costs. For operating income, we would take revenue of 8,400,000. We would take throughput margin of 6,055,000 and subtract it by our total cost of 5,300,000 to arrive at 755,000 for operating income. For May, we would take the 24,000 selling price and multiply it by our 520 units sold, which will give us an answer of 12,480,000 in revenues for May. For beginning inventory, we would take 6,700 in May for direct material cost per unit. And our beginning inventory was 150 units for May. That gives us 1,005,000 for beginning inventory. For direct material and goods manufacturer, we will still take the 6,700 from May of direct material cost per unit and multiply that by the 400 units in production in May. To get a total of 2,680,000. To get the cost of goods available for sale, we will sum up beginning inventory plus direct material and goods manufacturer. which gives us 3,685,000. For deduct any inventory, we would still take the 6,700 of direct material cost per unit in May and multiply that by our 30 units in ending inventory. Which gives us 201,000. To get total direct material cost of goods sold, we would take our cost of goods available for sale and subtract it from our deduct any inventory. Which gives us an answer of 3,484,000 for total direct material cost of goods sold. For the throughput margin, we would take our revenue in May of 12,480,000 and subtract it by our total direct material cost of goods sold, which gives us an answer of 8,996,000. For the manufacturing cost, we would take the sum of direct manufacturing labor cost per unit of $1,500 in May, plus manufacturing overhead costs per unit of $1,800 in May, a total of $3,300. Multiply by our 400 units in May, adding with our 2 million in May of manufacturing costs. That gives us a total of 3,320,000. For other operating costs, we would take the 3,000 in May for operating marketing costs per unit, multiply it by our 520 units sold in May, plus our 600,000 in May of operating marketing costs. Which gives me a total of 2,160,000. For total other costs, I would take the sum of manufacturing costs plus other operating costs, which gives me a total of 5,480,000 for total other costs. And to get operating income for May, I would take my throughput margin of 8,996,000 subtracted by our 5,480,000 to get 3,516,000 for operating income. With the answers that are in the yellow highlighted part, You could transfer these answers into the Pearson requirements. Once that's done, you move on to requirement number 2. Requirement number 2 says contrast the results in requirement 1 with the absorption and variable costing income statement presented. In April, throughput costing has the lowest operating income, whereas in May, throughput costing has the highest operating income. Throughput costing puts greater emphasis on sales as a source of operating income than does either absorption or variable costing. Give more motivation for NASCAR motor to adopt throughput costing. Throughput costing puts a penalty on production without corresponding sales in the same period. Costs other than direct materials that are variable with respect to the production are expense in the period of occurrence, whereas under variable costing they will be capitalized. As a result, throughput costing provides less incentives to produce for inventory than either absorption or variable costing. So this wraps up the video for chapter 9 on homework problem E9-7.